All right. Welcome to Coffee with Marcus and Mark. In this show, we talk about what's happening in the markets and how we're trading them. Today is Thursday, November 3rd. And in this show, traders hate the Fed. Dow sees a 1,000 point swing yesterday, and the 2-year yield hits 15-year highs. Also, does Apple rule the world? eBay, Roku, Qualcomm's earnings, and much more. Plus, I'll review my plan when closing options while trading the wheel strategy. As you can see, there's a lot to talk about, so let's go ahead and get started. If this is your first time here, welcome. My name is Mark Hodge, and I'm head coach at Rockwell Trading. I'm flying solo this week, but on most days, I'm joined by Rockwell Trading's founder, Markus Heitkoetter. He will be back with me on Monday, and even though I'm alone, I promise that you are in good hands. You could say that we have a lot of trading experience. We know our stuff, and we're not afraid to tell it like it is. If you're looking for some honest insights into the world of trading, then you are in the right place. Before we dive in and we look at our trades and how we're tackling these crazy markets, let's take a look at what's moving the markets today. And let me go ahead and jump right on over to the screen here and my charts, and here we see the S&P 500 right now. If you're wondering what's going on, it's all about the Fed. yesterday the Fed completed their 2-day policy meeting. They had their press conference. They announced their Fed statement and their decision on interest rates, and it was wild. Let's actually go to a 5-minute chart here because you could see exactly what took place. Markets, this is the S&P 500, down a little bit, just kind of going sideways, a little nervous, quiet markets, and then this huge move higher. Things were looking pretty good, and then this huge move lower. And I think that this kind of in a snapshot sums it all up. This was what I saw on CNBC when the statement was released, and it says that the Dow surges 300 points after the Fed hints at possible slower tightening policy. So in the statement, traders loved what they heard, but then you had the press conference, and here from CNBC just a little bit later, Dow closes 500 points lower, NASDAQ sheds 3% as Fed Chair Powell signals intent to continue hiking rates. And this is where we discussed the two different reactions, one being the interest rate decision and the statement, and then the actual press conference. In this case, that press conference was not well, traders hated it. Let's just be blunt. Look at what happened here. Just a big slide. Today, there was some more downside and a follow through. So we opened 1% lower. We are starting to close that gap. So coming off of session low, still in the red, still down for the day, but just a wild swing. So why are traders worried? Well, just to reiterate, with the statement itself, traders were actually excited by what they read. And this was that the Fed would consider the lagging impact of previous increases on the broader economy before making its next decision. So traders were thinking, hey, maybe we're ready to see this slow down, this hiking environment slow down. Maybe the Fed looks at inflation and thinks that we're peaking and at a point where they could be a little more conservative with hikes. But then at the press conference, just 30 minutes later, Powell said when they hear lags, they think about a pause. And it's very premature, in my view, to think about or to be talking about pausing our rate hike. Powell also said that there's a way to go and that ultimate or terminal rate would likely be higher than previously expected based on incoming data. Bottom line is that the Federal Reserve delivered another interest rate hike and signaled that no pivot or rate cut is coming anytime soon. And that's why markets sold off, because that's what they were looking for. The 75 basis point hike, that was priced into the market, as we've discussed all week. And really going for a couple of weeks now. So that was no surprise. But traders were hoping, that the future hikes would slow down and at some point come to an end and reverse and start seeing decreases in that rate. sooner than later. And actually, let's go to the FedWatch tool here, because now we see that for the December meeting. So actually, this is February. Let's go to December. Oh, that was December. My apologies there. Either way, we see here that the next FOMC meeting is 41 days. The traders can panic, go back and forth, be optimistic, be worried for 41 days, 2 hours, 54 minutes, and 13 seconds until the next statement. And here we see that for December, right now, a 50 basis point hike and a 75 basis point hike is pretty split here. But if we look at the probabilities, this is where we see that this 500, 525 range, another hike in December expected, another hike in February expected. This stays at this elevated level higher, and maybe we dip in 2013 of 2023. So bottom line, rates will, or at least based on the data, are expected to remain high. And that is why traders are a little bit worried. Although today, shaking off a little bit of the news, still down. We'll see where we end up. But with the news, with the expectation, with everything going on, let's take a look at the 2-year yield, because this actually spiked overnight, made new highs for the year, and was trading at 15-year highs. So the yields just increasing, and we know that there tends to be an inverse relationship between yields and the overall market. When yields are increasing, stocks are going down, and vice versa. And the 2-year yield just screaming higher because of that Fed news. Now, we talked about the VIX yesterday, and honestly, this was a little bit interesting because I mentioned that right now the VIX is kind of pulled back, and really it wasn't pricing in based on the VIX. We weren't pricing in this huge volatility. There was a move lower, but still based on options premium, we haven't seen this spike. Yesterday, the VIX actually was just barely positive, even though the overall markets was down. So that was basically saying that, hey, this volatility was already priced in. It was accounted for. It wasn't increasing after that big down day, which typically you see the exact opposite happen. The VIX is rocketing higher when you see a big sell-off like that. And even today, we were a little bit higher, but while the markets are down, the VIX now negative for the day. So a little bit of a disconnect. What this tells me is that we've kind of reverted back to this mean, to this average. And at least for now, traders, they had priced in more volatility going back to September and October. But at this point, we're kind of at this neutral zone where traders are saying, thinking, okay, we're at this point. What's next? There isn't this extreme fear, because if traders were expecting the market to fall 20%, this would be, jumping higher. That is over the next 30 days, right? This could always change. Right now, we're kind of in this neutral zone. So it's going to be an interesting ride. It's going to be an interesting couple of weeks, and an interesting trading period between now and the next Fed statement, since it really is all about the Fed at this point, and how they're combating these higher interest rates. But so far, there isn't a ton of fear, at least based on option premium, which is very interesting to me. So let's take a look at a few market movers here. Earnings also kind of taking a backseat to the Fed, but still something that investors and traders are definitely looking at. Here we have eBay. They reported they're actually pulling back a little bit. They were up much higher, but up 2.9%. They actually posted better than expected numbers, so better earnings per share than expected, also slightly better revenue than expected. They said that they expect better than expected third quarter earnings, boosted by its holiday sales forecast and renewed focus on value. So that's interesting. They also said that in the final months of the year, the revenue should rise modestly. although the ongoing surge in the US dollar would act as a headwind to its international sales. So that's something that we're going to hear more and more about. It's the dollar. The dollar is super strong right now, and it does have an impact on companies that do have international exposure. So eBay addressing that. Now, another company reporting earnings, just to take a quick look, is Roku. Roku just a nasty, nasty move lower since the pandemic optimism of this company, trading 7% lower, although coming well off of session lows, which is nice for any Roku holders. They plunged. Here you could actually see that the earnings per share, the loss wasn't as bad as expected. Revenue came in better than expected as well. But the concern is the future guidance here. So they warned that the holiday ad spending will be sharply lower compared to last year. They also said that looking into the final months of the year, it's macro environment for further pressure when it comes to consumer spending. That's going to have an impact on these advertising budgets, where revenues could fall 7.5% from last year. And that's not good when you start to see that forward guidance be lowered, because, again, positive numbers top and bottom, but what's going to happen in the next quarter? That's why traders sold Roku and why Roku's down. Another company that not doing too hot today, Qualcomm, also down 7%. Now, they also reported slightly better, all pretty much in line with EPS, but slightly better revenue as well. So an earnings beat, revenue beat, but they said that the current period will likely be well shy of analyst estimates because of a rapid deterioration in demand and easing of supply constraints across the semiconductor industry. And that's having an impact on Qualcomm. So although it's at a decent ranges, not as bad as something like Roku, finding some nice support, but breaking down and now breaking through that support level, down 7%. So some mixed earnings, a little more on the downside recently compared to what we saw before in the earnings season. But earnings season will continue and carry on, and we'll see where this goes from here. Now, I saw something posted about Apple, and I wanted to share this because this is pretty wild. So if you look at Apple remains strong. They are the king of the world here, even though they're down 3%. Apple, let's actually look at we go to Apple. Apple's market cap, based on yesterday's close, is bigger than Google or Alphabet, Amazon, Meta combined. What a difference a year makes, right? I mean, look at Amazon. Amazon down considerably. So Amazon's chart a lot nastier than Apple. Meta, just the worst of the bunch, just getting hammered. From 380-ish down to $90. And then we could look at Alphabet, Google, and we see that Google slide getting cut in half where Apple remains strong. So I saw that number, and that's just crazy to think, based on where we were trading in 2021, even the last quarter of 2021, Apple now, based on yesterday's close, has a market capitalization that was greater than Google, Amazon, and Meta combined. Crazy, at least for me, to think about that. So let's take a look at, speaking of Google, I am in this trade. Markus is in this trade as well. And I think it goes back to the ad revenue spend being a bit of a concern, just like with Roku. This is one of the reasons Google is falling, right? Now, should I panic? Should I get out? Should I throw in the towel? Well, whenever I decide that a company is worth investing in and I want to trade the wheel, I am looking for a nice win to be in the trade for maybe a couple of weeks, but I'm also willing to manage the trade. And that is what I'm willing to do at this point. I'm hoping that we get a nice rebound. I do believe that if you've picked a good stock that has good fundamentals and you are looking at some nice support levels, that if we do pull back, there's greater potential that we'll get back. We'll see some buying interest take place on these levels lower, where traders now see value. Like, hey, if it was a good deal and it's a profitable company, back here at 100, now that it's at 85, that's where traders tend to step in. And so a 5 to 10% pullback in a wheel trade, based on my analysis, based on what we look for, our 4 steps when picking a stock to trade, that would be expected. That would be par for course. 10 to 20%, a little bit more extreme, not as common. But right now, I'm still in Google, and if I need to do a rescue at some point, I will do it. I'm not concerned about that. But of course, I'd like Google to be higher, but I'm still comfortable owning this stock. So I am owning it still. Markus is. And right now, at this point, there isn't anything to do, but we will keep an eye on it. And hopefully we'll see it turn around so we can start selling calls again, or we will add to the position when it makes sense. So that's what's going on with Google. I want to bring up LVS because I mentioned yesterday that this is also a position that both Markus and I are in. And I mentioned that I sold the 42 calls for 32 cents, and I bought back those calls. So I wanted to share what my plan is when it comes to options, whether we're selling puts or selling calls, and we're trading the wheel. Let me go over to PowerX Optimizer, and let's go to the calculator here. If we go to the calculator, you'll see here that there's this 90% profit number. So we have 2 parts to the calculator. We have selling puts and we have selling calls. On the put side, this 90% profit target, this is what Markus and I like as an exit up until the last day of expiration. So what does this mean? Well, in this example, the premium potentially was $1.25. And if we have an opportunity to buy it back at 13 cents, that's approximately 90% of the max profit we can get, because when we sell an option, whatever we collect is the most that we're going to profit from, right? So if we could buy it back at 90%, the reason to consider this is we've already squeezed out most of the profit on it anyway. And now we have an open position, so we could utilize that extra buying power to put on a new trade. So that's what we do with puts, and the same can be done for calls. Here I could slide over and look at the LVS calls because I sold the 42 and I collected 32 cents. And here, if we come down to this level, we see that, okay, the 90% profit target is 3 cents. So that's saying, hey, if I could close it, if I sell it for 32 cents, if I sell those calls for 32, which I did, and I buy it back for 3 cents, I'm giving up 3 cents, but now I freed up that buying power. In this case, because it's covered, it's not as important. But if I sold for 32, I could buy it back at 29, let's say. Now, what happens if on Thursday the stock rallies again, or on Friday the stock rallies? And now, because I no longer have those short calls, I can sell calls again. So that's what I like to do, buy it back at 90%. But I do have a personal modification to this rule for my plan, and that is if I can take an 80% max profit on a put or call that I've sold in one day, I'm going to go ahead and do that. Because when I put this trade on, here we see this premium per day, $240 a day right now based on that 32 cents. However, I actually closed this for 5 cents. So if I was to get 5 cents, right, if I was to stay with that trade for today and tomorrow, it goes from a real nice premium per day to just 38 bucks a day. Let's just make this 100 shares to kind of just keep it per put to make it easier to analyze here, right? If we base this per put, then here I'm making just $3 a day for the rest of this period. And again, when I originally put this trade on, it was $16 a day times the position I'm trading. So that's a rule that I like, the 80% profit rule in one day. Otherwise, Marcus and I will use a 90% rule. And if we haven't closed that trade at 90%, then on Friday, the last day of expiration, we'll go ahead and let that go, just because at that point, it's kind of like free money, right? If you're going to get a sign, that's okay, because we put the trade on with the intent of getting assigned at the strike that we sold. But if you have a couple of pennies left in that option and it's going to expire at the end of the day, we'll normally just let that go and let that happen. So anyway, that's my plan when it comes to closing puts and calls. 90% of its max profit. The calculator here in PowerX Optimizer makes that super simple. And if it's a one-day trade where I could get out at 80% or more of the max profit potential, I will go ahead and do that. So that's going to do it for today's video. I hope you liked the review. If you did, give it a like. I also hope you liked the discussion on closing calls and puts here and what my plan is. If you did, give it a like. Give the video a like. We'll see you here tomorrow. Once again, I will be solo, and then Marcus will be back with me next week. But until tomorrow, happy trading, everybody.